Hello, welcome back to the channel. I hope you are having a fantastic day today. So in today's video, we're gonna be talking about something very important for those who are financing their home. So if you are buying your home with cash, this video does not apply to you. You can click off right now. But if you were just wondering, hey, I'm going to be financing this home and I'm wondering what exactly will make a lender deny my mortgage, you want to stick around and watch this video till the very end, because we're going to unpack the very critical details or the the valuable information that you do need to understand when it comes to lenders denying your mortgage, especially after you've been pre-approved. But before we dive in, if this is your first time stopping by this channel, welcome. Consider subscribing now to join this amazing community to stay informed on the latest helpful and exclusive tips for your financial wellness and success. And one more thing, be sure to give this video a thumbs up to help other people find this information quicker. Okay, so let's jump right into it. What is the very first thing that gets the lenders to deny your mortgage? So the very first thing I want to share with you is a drop in credit score. And what exactly do we mean by this? This just means that from the time you got pre-approved till the time you get approved for the loan, so that window between the application of the mortgage and the final approval of your mortgage, if your credit score drops, that's going to be a red flag. That's a problem, because lenders do not want to have a situation, especially when it drops drastically. Lenders do not want to have a situation where they rent to people who are considered high risk, and this will impact your interest rates you get. So lenders want to make sure they are giving you the loan based on the risk matrix, based on the proper risk matrix or the risk assessment that they've had on you. So the underwriters are going to look for your credit score, and if you do have a significant drop in credit score, this is a red flag. So you want to make sure you keep a watch on your credit score and avoid this from dropping drastically. What is the next thing? The very next thing that lenders look for is an increase in debt. So what exactly do we mean by an increase in debt? This is your debt burden. Remember, this is very important because lenders always use your debt to income ratio to approve you for a loan, and your debt to income ratio is basically how much debt you carry versus the income you bring in. So let's just say you have a very high debt and you have a low income. There's going to be a problem. But let's just say when you got pre-approved for the loan, your debt to income ratio was like, I don't know, 75%. Some lenders may not lend to you if you just racked up a whole bunch of debt during the approval process, and now your debt to income ratio is say 45%. That is a huge red flag. So you do want to make sure you keep your debt load on the low. So you want to make sure you keep it very low during the mortgage approval process. What's next up here? The next thing I want to talk about here is your change in job or income. Yes, while changing a job or changing careers may be a good thing for you, your employment history matters whenever you are going out for a new mortgage, because this indicates stability. But not just that, let's just say from an income standpoint, you do have a significant drop in income. Lenders are going to be wary. I mean, they get concerned when they see that, especially when you applied with a high income and then now you do have a lower income. That's going to be an issue for them, and they may likely deny you for this single reason. Okay, now the very next thing I want to talk about here is the low appraisal. This one, guys, is very important. And the reason this is very important, not just for the lenders, but also for you. You know, this low appraisal just means that the home is overvalued. Who wants to buy something that's worth way less than who wants to pay for something that's worth way less than the price they're paying for it? But unfortunately, people do this all the time. So especially in this market where people are outbidding themselves and putting in way higher offers than what the home is worth. So you do want to protect your basis, but not just that. The lender wants to make sure that they are protected, because the home is the collateral, or so the home secures the mortgage that the bank gives to you. So you do want to make sure that the home you're purchasing is not overvalued. So a good analogy here will be, let's just say you're trying to buy a home for $150,000, but this home is actually worth only $100,000. And even if you put down 20% on the $150,000, that's only $30,000. You still have to come up with another $20,000 in order for the bank to approve the loan, because the bank is not going to give you an extra $20,000. So the $120,000 that you do have in loan has to match the value of that home. So something to note is that whenever you are going out to purchase a home, the bank is not going to lend you what is over the amount of the value of the home. So you do want to make sure that you pay close attention to the appraisal. Look at the comps in your area and make sure you are not overpaying for the home. Now the next thing we have in here is phantom funds. So let's unpack this for a second. Phantom funds or ghost funds, whatever you want to call it. This is simply funds that no one can track. So let's just say you went out there and all of a sudden $20,000 appeared in your bank account out of nowhere. So what is the bank going to ask you? When they ask for your statement of account, they're going to be tracing the funds. So where did this come from? If you cannot explain where the $20,000 came in from, chances are that they're going to deny you. So the very typical situation is when people get gifts. Maybe you're trying to buy a home and the family or friend gives you some money to put towards your down payment. You do want to get something called the gift letter. So if this is not, if you don't have this record, you may get denied for the mortgage, because the bank is thinking maybe you are going out there and borrowing $20,000 to put down on the home to use that as the next step up to get the mortgage. So they don't want you to basically rack up more debt to get the mortgage. They basically want to make sure that you have the funds for the down payment. So something you want to do is to make sure you have a track record for the money that you're putting down. So ghost funds or phantom funds is something that gets your mortgage denied. So what else are we looking for in here? Now the very next steps is what we're going to talk about. Now that you know the key things, the core reasons to why your mortgage gets denied by lenders, let's talk about some solutions here, because we don't like to talk about just problems. So here's a solution. The next thing you want to do here is track your credit score. Your credit score is an indication of your credit habit. And what do I mean by that? You want to make sure that before you go out there and apply for a loan, you are basically paying off your balances. You are basically doing everything within your willpower to build a good credit, because your credit score will determine not only the interest rate, but also will determine how much money you have left over in your pocket at the end of the day. So you want to make sure you maintain a very good credit, and also be sure not to taint your credit score shortly before you get approved for the loan. And then the next thing you want to do here is to delay big purchases. So delayed gratification. So let's just say you're trying to buy a home, and when you are in the approval process, you want to hold off on applying for new credit cards or getting into new debt. So you don't want to get into new debt during the mortgage approval process. This is something that most people do not understand. So you want to make sure you are staying away from racking up any new debt. When you go to Costco or you go to, I don't know, the grocery store, or you go shopping and they ask you, hey, do you want to sign up for this card? Just tell them no thank you, because guess what? When you sign up for that card, that's going to impact your credit score, because the lenders are going to pull your credit score, and that's a hard inquiry on your credit. And also, if you do put the new purchase on that credit card, that will increase your debt to income ratio. So you do want to stay away from big purchases. Something that you need to understand. Now the next solution here is to avoid changing jobs if you can. So if you absolutely can, avoid changing jobs, especially when this brings about a drop in income. So let's just say you are changing a job and now you're making less money. Remember, your debt to income ratio is something you want to keep in check when you are applying for a mortgage. So you want to do everything possible to maintain the same or higher debt to income ratio as during the pre-approval process. Now the next stop here is to request a gift letter. I talked about this previously. So if you do get a gift as a down payment, let's say you get a gift from family and friends to put down a cash gift. Maybe you got a check of $20,000 to put down on a home. That's something you want to make sure that you get a letter for. So you want to have whoever is giving you the money write you a gift letter saying that, hey, this is not a loan, this is a gift. And that's what you can take to the bank, and the underwriters at the lender at the bank, or the lender underwriter, basically uses this gift letter to get you approved. But if you don't have a record of the $20,000, that could be a problem for you. So you want to make sure you always have a trackable record of any funds you intend to use for down payment. So I hope this helped you out, and I hope this actually gave you some value. And the very important thing that I want to point out here ultimately is that you do need to create a plan and stick to the plan before you go out there and start applying for mortgages or for loans. So let's just say you know the house you want to buy, you want to know your limits, you want to know how much home you can afford. So you basically want to go out there and do the math, look at your income, look at your debt, and understand what your debt to income ratio is, because this is a huge determinant in how much you can afford. So you don't want to go out there and spend your time and energy and at the end of the day you get denied. So have a plan, create a plan, and most importantly, stick to the plan, and you will never have your mortgage denied if you do the right things and have a plan that works for you and stick to that plan. So I hope this helped you out, and if you have not subscribed to this channel, be sure to do so right now to avoid missing out on the awesome, helpful, and exclusive tips on this channel. One more thing, be sure you have a great rest of your day, and see you in the next video.